Hey team, today we're breaking down one of the most deceptive patterns you'll ever see on a chart, the bear trap. You've probably seen it before. Price looks like it's finally breaking down, support gives way, traders pile in, short, and then out of nowhere, the market snaps back up. One move and suddenly everyone who thought they caught the perfect entry is on the wrong side of the trade. Stops get hit, positions flip, and momentum reverses. That's a bear trap, and it's a pattern that repeats across every market and every time frame. In this video, we're going deep into what creates that move. It's not just a random price action, it's usually a mix of liquidity, emotion, and positioning. The market hunt stops sitting under obvious levels, triggers them, and then uses liquidity to fuel a reversal. We'll start by looking at a few clean technical examples, simple horizontal support breaks that fake out retail traders. Then we'll move into more complex ones, traps inside channels, descending wedges, and broader market structures. You'll see how the pattern shows up differently, but the psychology behind it never changes. Sellers think they've caught a confirmed breakdown. Buyers step back in quietly, volume stays light, and then one strong green candle wipes out the entire move. I'll walk you through 6 real charts, straight from the markets, each showing how the trap forms, when the confirmation fails, and the exact moment the reversal takes hold. Pay close attention to the volume profile and candle behavior in each one. Real breakdowns have conviction, increasing volume, clean structure, and follow through. Traps don't. They slip under the level, pause, and then snap back. We'll also talk about the practical side, how to spot the warning signs before you commit. Things like low volume breaks, indecision, candles at key levels, or fake follow through. That immediately retraces. The goal here isn't to make you afraid of short setups, it's to give you the confidence to tell the difference between a real shift in a trend and a market fake out designed to take your money. By the end of this video, you'll have a clear blueprint for recognizing bear traps in real time, not just after they happen. Alright, let's get into it. Here's what a bear trap really looks like and how to avoid getting caught in one. Price was in a clear downtrend inside a descending channel. In July 2023, a bearish engulfing candle formed near the top of the channel, signaling a potential continuation lower. Price then broke below the lower boundary of the channel, appearing to confirm the breakdown, but volume remained weak. Shortly after the break, price reversed sharply upward and closed back inside the channel. That move invalidated the breakdown and forced short sellers to cover their positions. The reversal marked the start of a new rising trend, forming higher highs and higher lows through late 2023. The failed breakdown and fast recovery defined this event as a classic bear trap. Okay, in the next example, price trades within a range establishing a clear support level. A bearish move breaks below that support, giving the appearance of a confirmed breakdown. Sellers enter the market expecting continuation to the downside. Instead, price quickly reverses back up above the support line. The move triggers stop losses for short positions and forces short sellers to buy back. The failed breakdown and fast recovery identify this pattern as a bear trap. In the next chart, price forms a horizontal support line after a period of consolidation. A red candle closes just below that support, suggesting a breakdown. Volume is limited, showing weak conviction behind the move. The following candle forms a strong green bar with a long lower wick, pushing price back above support. The quick recovery invalidates the breakdown and traps short sellers. The combination of a false break and a sharp rebound defines this as a bear trap. Okay, next. The chart shows a price consolidating above a clear support level. Price breaks below that support, appearing to start a downtrend. Sellers enter the market expecting the continuation lower. Volume remains muted during the breakdown. Price then quickly reverses direction and moves back above the support line. Failed move downward traps short positions and triggers a rally, confirming a bear trap before the subsequent bullish phase. Okay, for our second to last example, price builds a base after a prior up move, forming a clear support zone. A small breakdown occurs below that support, but the candles are narrow and volume is light. Price quickly rebounds with a large green candle that closes back above the level. The failed breakdown forces short sellers to exit, fueling upward momentum. The recovery confirms that the initial move was a bear trap. Okay, and for our last chart, price trades within a falling wedge pattern, making lower highs and lower lows inside the formation. Near the end of the wedge, price briefly breaks below the lower boundary, signaling a potential continuation of the downtrend. The breakdown fails quickly as buyers step in and push price back above the wedge line. The recovery triggers short covering and leads to an upside breakout. The false move below support identifies this as a bear trap within a falling wedge reversal setup. Alright team, that's the breakdown. 6 real bear traps straight from the markets. Each one looks different, but the story never changes. Emotion, volume, and structure decide who gets caught. The goal isn't to avoid every trap, it's to recognize them fast and to react with discipline. If this helped tighten up on how you read price action, hit like, drop a comment, and share it with someone who trades. The next video drops soon. We'll dive into bull traps and how to spot the reversal before it happens. Until then, trade smart, stay patient, and I'll see you in the next one.